China news here. Global ride-hailing giant Didi now saying it will delist from the New York Stock Exchange less than 6 months after going public.
This week, Didi announced that they were going to delist off the New York Stock Exchange less than 6 months after they IPO'd on there. So if you've clicked on this video because you are concerned about owning stocks like Alibaba or Neo, which may potentially delist as a result of this action, then you've come to the right place. In this video, I'm going to provide my rationalized view on why I think the likelihood of a company like Alibaba delisting off the New York Stock Exchange or the US stock exchanges is really low. Hello and welcome to The Nimble Nomad. My name is Arjun and this is the channel where we talk about money and investing. So in case you're new here, please consider subscribing as I talk a lot about money and investing. I come up with new content every single week. So in case you've not been following the news with the equity markets and the stock market this past week, boy, what a week it has been to miss out on the news of what's been going on. So apart from the obvious COVID-19 impact of the Omicron variant of the virus and the havoc that caused on the stock market, there was big news coming out of China. So there were two big headlines that came out of China. On November 29th, Reuters actually put out a headline which said that the US and Chinese regulators were working together to avoid a mass delisting of Chinese stocks from the US stock exchanges. Then on 1st of December, Bloomberg actually reported that through an unnamed source in the Chinese government, that the Chinese government and the regulators were working to shut down the VIE structure, which enables Chinese companies to list in the US stock exchanges. Now, if you don't know what a VIE structure is, basically I did a video about this. I'll add a link of it there. But it's an offshore structure that these Chinese companies use in order to bypass Chinese laws which prevent foreign direct investment and allow them to list on the US stock exchange. Basically, they come up with these offshore companies based in places like the Cayman Islands, and if we want to buy stocks of these Chinese companies, buy shares of these offshore listed companies. Now, this actually is a huge risk if you're a retail investor looking to buy any Chinese stocks. And it's probably the biggest risk that you need to be aware of because what that essentially means is that you don't actually own shares of the actual company that you're buying. You're buying shares of this offshore listed company, which is based in places like Cayman Islands or Canary Islands or wherever, right? So now what does this actually mean for Alibaba's stock? So as I said in the beginning of the video, a lot of what is happening with the Chinese companies that are listed in the US stock market is because of what has happened to Didi. So Didi obviously decided to delist less than 6 months after they IPO'd on the stock exchange. And what that meant was companies like Baba and Neo lost a significant amount of their market capitalization in less than a day. So Baba dropped by 8% on Friday this week, and Neo dropped almost as much as 12% per day in one day. Now, if you look at Alibaba, because of this one risk of delisting, it has lost more than 50% of its market capitalization since the beginning of this year. And I think this is a really, really strange reaction, right? I think the market is massively overreacting because if Baba is at risk of delisting, then every single other company which is listed on the US stock exchange from China is equally at risk of delisting. But if you look at these other major Chinese stocks, JD.com, for example, in specific, it has only lost 3.5% year to date on its market capitalization, which is really strange because JD.com firstly is a primary competitor to Alibaba. Secondly, it uses the same VIE structure, yet it has not had the same impact. So I think this is an overreaction. Now, on to a more specific scenario, which is, I think, the way that the stock market is comparing Didi with Alibaba is not a fair comparison. So in my opinion, I think Didi is a very, very special case. So Didi originally wanted to list on the Hong Kong Stock Exchange and they could not because they did not meet any of the requirements or did not meet the minimum requirements for the Hong Kong regulator in order to be listed on the Hong Kong Stock Exchange. So instead, what they opted was to go and list in the US on the US Stock Exchange because the requirements on the US stock exchanges are a lot more lenient.
I'm confused. they couldn't meet the requirements to originally list in Hong Kong. That's why. So we have lesser requirements in the United States. That's what happened, and now they're flipping the script.
Yeah, actually, there are a lot of Chinese companies that go to the United States because they say that the regulations there are much looser than they are for Hong Kong. And same for Shanghai, where in Shanghai for a very long time, they required that companies make a profit, prove they make a profit. In the U.S., you don't have to prove you make a profit. You could list there, and that's not a problem.
Now, before Didi actually listed on the U.S. Stock Exchange, they were warned by the Chinese regulator and the government not to do so because there were some compliance issues from a cybersecurity and data privacy perspective, which the regulator was concerned about. Yet they went ahead and decided to list on the US Stock Exchange. Now, as soon as they did that, the Chinese government came back really hard on them, shut down their services in Hong Kong and in China, and that had implications immediately on their business. Now, if you compare this with Alibaba, Alibaba has been listed on the US Stock Exchange for more than 5 years without any problems as far as what is going on with Didi. And moreover, they have most recently paid $2.78 billion in fines because they didn't comply with the antitrust requirements of the Chinese regulator. And they've also made a commitment of paying $15.5 billion over the next 4 years, which is a contribution to China's Common Prosperity Initiative. So this is all President Xi's approach in sort of what he wants to further the China initiative. So if you look at the comparison between Alibaba and Didi, in short, Alibaba is the good boy and Didi was the naughty boy on the naughty step. And I think it's unfair to compare the two companies like for like from a risk of delisting perspective. Now, beyond all of this, I want to mention a couple of facts which make me think that the risk of Alibaba delisting is quite low from a likelihood perspective. And I want to specifically go into some facts that I had to really dig deep into. So as of May 2021, there were 248 Chinese companies listed on the US stock exchanges. Of these, 8 of them are state-owned. Now, moreover, Alibaba is the biggest company out of all of these 248 by market capitalization, which is listed in the US. Obviously, the market capitalization has dropped significantly since the year began. But having said that, if there is a risk of if there's a risk of Alibaba delisting, which is the biggest one, then that basically means every single one of those 248 companies, including those 8 state-owned Chinese companies, needs to delist off the US stock exchanges as well. Moreover, if you look at the sort of almost, US, China, everybody's talking about this tension between them. US as a country is not some small, piddly little crappy country. US is one of the biggest trade partners for China. And the net impact, I guess, from an investor perspective of these companies which are listed on the US stock exchange, according to one fact quoted on Asia Financial, was there was $1.1 trillion of US investor money in the top 5 companies of those 248 which were listed on the US stock exchange. So if there was a delisting, there is going to be a massive reverberation across the stock market in terms of impact to investors like you and me. Now, overall, from a risk perspective, I think you have to break down risk into likelihood and impact. So I think in terms of impact, yes, because of the sheer number of companies and the size of these companies and the popularity of these companies, there's going to be a massive impact if there is a mass delisting of Chinese companies, including Alibaba and some of these other companies. But I think if you think about the significant impact and what that means in terms of the fact that China is basically saying we don't want Western capital and the only way you can access or give us capital is through our own stock exchanges, it just doesn't line up with the broader goals of what China wants to achieve. So in my opinion, right, as a random guy on the internet, I honestly think that the likelihood of this materializing is really, really low. Yes, there may be companies which are smaller, which could delist and succumb to pressure from the Chinese government. But I think a large company and a popular company like Alibaba delisting off of the stock exchange is really, really low. I think ultimately, even if it does delist, I think the main concern is not the actual delisting itself, because if you look at some of the other companies which have delisted recently off of other stock exchanges, so Ryanair from the London Stock Exchange, or Shell cancelling its dual ownership structure in Netherlands and the UK, I don't think it actually means much from a stock price perspective. I think the main concern is whether you can convert those US shares into Hong Kong shares and still continue ownership of that company. I mean, honestly, for me, Alibaba forms a significant proportion of my own personal holdings, and I'm hoping that it doesn't happen. But then again, this is my opinion and my opinion alone. I hope this video helped you out, and if it did, please smash that like button and don't forget to subscribe. I'll see you in the next one. Goodbye.